Well, we'll talk about sort of some of the local cues, but let's go back to the global stuff, right? Gargi Pal Chaudhary is head of iShares Investment Strategy, Americas at BlackRock. She's with us now to take some questions. Gargi, great to have you with us here. Thank you very much for your time. Prashant Desai, it's good to see you here on the channel. I hope the first of many. I want to start with, we'll get to the US in just a bit, but the dollar JPY back at in the 143 handle now. Compared to 147 just 2 days back. What's going on? And do you think it's got the potential to once again sort of induce some fear in markets? Or do you think it's one and done? It won't cause the same kind of impact again. Your thoughts?
Sure. Good morning. It's very nice to be here. Long-time listener, first-time joiner, and thrilled to join you and your guest today. Starting with your first question on the dollar yen, look, I think that we're leaving this environment of a lot of liquidity, a lot of reserves, and more moving, at least in Japan, to an environment of more restrictive rates. And I think when you move from an ample liquidity regime to one of more restrictive policy, you are going to have to get used to a certain amount of volatility in the markets. And we certainly saw that in the beginning of August. Some of the positioning, we obviously look at, much like I'm sure you do, look at some of the non-commercial yen futures forwards holdings, and to some extent, some of those have been unwound, some of those shorts have been unwound. But I think as we get to restrictive levels, and for sure the Bank of Japan is going to continue to move towards higher rates, I think we should get used to some periods of volatility and expect them to be a part of normalcy in our markets. I think just as we saw in the beginning of August, it created an opportunity for those that were patient and willing to sort of stay the course.
Yeah.
Gargi, just to finish that point, this was, I think, early this year, it was last year, there was someone who said, who called Japan's rising interest rates as the San Andreas fault line of finance. That got a lot of play, obviously, because of how it was phrased. But I think yesterday or day before, you had the head of fixed income at T. Rowe Price, who essentially warned that, and I quote, "We've just seen the first shift in that fault and more is to come." You wouldn't sort of, listening to you, you wouldn't go that far, right? You're saying, well, markets will very quickly get used to this.
I just think that we are going through a massive regime shift globally. And I think what we have now begun to see in Japan after many decades will take investors a little bit of time getting used to. I don't think that every single move will be a 12% drop like we saw in the Japanese equity markets in the beginning of August. But I think to expect no other ramifications of a rate hiking cycle is a bit too optimistic. So I do think, again, as I said, if we move to more a regime of more volatility in the markets, a regime of more restrictive rates, we can possibly see some further carry unwind trades, which is kind of what we saw in August. And I think volatility is really poison to those carry unwind trades. And I think I don't expect this to be anything that's going to shatter global market liquidity. I think if anything, it gives us opportunity to pull back, reassess our views on where we think markets make sense, whether that be in Japan, India, or US, growth versus value, and look at better levels to reassess and enter markets. And that is exactly what we told investors to do for the Japanese markets earlier this month.
All right, Gargi, interesting point, and makes a lot of sense, right? That there's no point expecting that this one-way ride, the one-way yen carry will just, carry on forever. So take your point. I think August has taught us that, this needs to be watched with a little more nuance. Okay, let's talk about the U.S. market itself then. You look at investment strategy across Americas. And here we're dealing with two issues. One is what's happening with the economy and whether we're getting a soft landing or not. And maybe to an extent, the Fed fixes that with the rate cut. And the other is this whole issue around AI, right? The volatility that we're beginning to see in the tech space, in the semiconductor space. What are your thoughts? Are you still constructive on U.S. equities?
Sure. So we'll start with the first one, which is just around, the normalization of interest rates that we think is going to happen later this month. I think the Fed has prepared us in the Jackson Hole meetings that took place at the end of August. They very much prepared us for the rate cutting cycle to begin later this month. Now, the question is whether they go 25 or 50. I tend to be in the 25 camp. Obviously, the market's pricing in about, as you had said earlier, a 50% or so chance of a 50 basis point rate cut. But I think they want to be a little bit more patient. And obviously, inflation isn't back at their target, certainly making a lot of progress, but isn't quite back at their target yet. And I think that just this act of normalization of policy, just this idea that the Fed is now focused on their dual mandate, and that's one of the things that was most important in Jackson Hole, the Fed saying that right now they don't welcome any further weakening. They don't want any further weakening in the labor market. That brings back a lot of optionality for investors looking at both bonds and equities. To the second part of your question, I think September and October in the US tend to be pretty seasonally volatile. We've seen that over the last decade when you look at, what equity markets, whether you look at small cap, whether you look at large cap, whether you look at more of the tech stocks that you're talking about, wherever you look, whichever corner you look at, we have historically seen some volatility in both September as well as October. Now, on top of that, you do have other macro event risks, such as the US elections. So I think that it is okay for us to get used to, like I had said, even with Japan, I think even in the US, we saw that in the beginning of September already. I think that we should expect some volatility, both in equities as well as in bonds in this month. Be ready for that. I'm telling my clients that's okay. Volatility is normal seasonally at this time of year, especially going into the US elections. We certainly think in the 6-12 month forward picture, high quality US equities will continue to do well as long as, growth, which we think is continuing to be very close to or above potential. The Fed begins their rate cutting cycle, which has, again, historically been very good for both stocks and bonds. So the longer term picture, if you look 3-6 months out, looks really good. For the months of September and October, again, depending on your time horizon, I think we can see a little bit of volatility. And I think investors should get prepared for that and not be spooked by that.
Okay, Gargi, good morning from here in India, and good to see you in. This is Nigel on this side. So plenty of pieces of the global puzzle and bracing for some volatility in the near term. But what about an emerging market like India? We have been a big outperformer. Earnings growth looks good out here. Political stability as well as something that, we boast of. But at these valuations, what's the view on the Indian markets from here on?
Yeah, I mean, it's been my absolute privilege and pleasure to talk to investors across the Americas. So I cover US, Canada, and Mexico, and talk about my country of birth and where I've studied and grown up, which is India, obviously, as you can tell. And the story has been wonderful. And I think that, yes, valuations are at the higher range of the whichever historical period you look at. But I think there's another broader story here, especially when I look at portfolios in the US for US investors. There is an underinvested story that is true of India, certainly, but true broadly of emerging markets. So I think this isn't even about valuations. As India becomes more and more important to the global economy, as it already is, but as we continue to take our place, take our seat in the global stage, I think investors need to at least get back to benchmark weights with respect to EM and with respect to India specifically. And I think that is the opportunity. Now, can we see some volatility, especially as you pointed out, around these valuations, as well as the point that I was making earlier around a little bit of US seasonality in September and October? Absolutely. But from a long-term perspective, as I said, it's been my absolute pleasure to talk to US investors about the opportunity, about the medium to long-term opportunity in India, which isn't going away anytime soon. And I think investors need to continue to move towards a benchmark weight, even if not an overweight position, to emerging markets and India specifically, which they are not at currently. So I think there is more of that trade to go. And again, nothing is ever a straight line. India, obviously, after the elections, provided a really good opportunity for investors. We've seen a really nice outperformance. I think we can see some pullback, but it's not the end of the world.
All right. Rarely ever is, right? Thank you very much, Gargi. Appreciate you joining in, and it's a pleasure having you here on CNBC TV 18.
Absolutely.
And as I said, look forward to many more. Appreciate it. Well, we'll